Good afternoon, guys. So we had some great conversations about markets. Being me as a fund manager, there are thousands of questions which are asked to me. So I'll take this privilege to ask these 4 fund managers. So let us keep it candid. We keep it something which you have with starting $1 billion question, because million is now small, right? So we all talk on billions, right? So 1978, Kenny Rogers wrote a great song of the gambler that a great gambler is who know when to hold it, when to fold it, when to walk away and when to run, right? So the $1 billion question right now is that what should be done? What do you take as in asset management, your company, because your market has done superb, returns has been brilliant, everybody has been happy, fear is there, I'm sure, What do you see? It's the time to run, hold, fold or walk away, and giving some logical reason out of it. We start from you, sir.
Thank you. So there is no running away, because the idea is that you, whatever be the case, you try to navigate within the existing circumstances, right? So here we are seeing now a situation where if you slice and dice the indices, you're getting certain interesting data out of it. So late 90s, early 2000s, you could capture most of the upside in the market via the top 30, 40 names, because they were organized, the corporate governance was great. Whereas the bottom of the pyramid, corporate governance was lacking, unorganized was more, number 2 Kadanda was higher, and so on and so forth. There was no GST, no tax compliance. But now it seems to be a bit of a reverse, where most of the growth of the large cap is coming outside of the Nifty. So for example, Apple in India is a 70,000 crore company. Amazon is a 50,000, I'm talking about the Indian operations, right? So Amazon is a 50,000 crore company, Google is a 40,000 crore company, Microsoft is a 25,000 crore turnover company, Cisco has increased its turnover by 8x. These are all companies which are not listed, these are all the top US companies, and these are all top line numbers that are greater than Cipla, Sun Pharma, Bajaj, Hero and all these type of companies which are present in the Nifty. So what we are seeing now is a mirror image of what was there in late 90s, True. Early 2000s. True. Where the bottom companies are becoming more organized, more GST, more compliance, many more sectors to play, whereas the top has become a little bit on the legacy side. So that is one of the reasons why your BSE midcap and small cap has given 2x the returns of Nifty, I would say.
This is the time of run or hold?
I would say hold.
Hold, perfect, superb guys. When we start from you, what is your take on markets and what do you suggest, or what do you take action in your PMS?
Yeah, so we are a long,
AIF, sorry.
AIF, yeah. So we are a long only AIF. So like Vedanath said, no question of running away. In fact, any opportunity we get, we keep looking at newer opportunities to add. And very strange as it may seem, we've actually got the maximum inflows in the last 15 days, and that's a reality, harsh reality. So we are in the business of trying to look for those kind of opportunities. Initially, of course, you try and go back to the same trusted names which you own and try and allocate some capital there. And of course, like we all know, it's no longer a market with 30 or 40 stocks, and there are many indices, many stocks, many sectors and subsectors to look for. So there are ideas aplenty. Last year you had certain themes which played out very well. So if one was lucky or one had the foresight that this will happen, great. But that doesn't mean that those very sectors may not participate going forward. And there are obviously new opportunities as well. So we continue to actually be buyers in the market.
So just to tell, run is getting new, being aggressive. Yeah, hold is of course hold. Fold is to book profits, and run away is to exit out and take money from the markets, right? So you guys, you have done amazing in your PMS. We were talking, off the table, and you had some great ideas. What do you suggest? How has been your tenure, and what is the future? What you are looking for?
Well, thank you. So I think there is no one answer to it. Different. We can surely answer where we are right now, but overall you have to look at the markets very objectively.
True.
One thing that I've realized over my 16-17 years of experience is that you cannot have any biases in the market. मैं ये करूँगा, मैं ये नहीं करूँगा, right? I will do large caps, I won't do small caps, I will do contra, I won't do quality. So if we see let's analyze the past, say past 35 years, right? So 1992 we all know was like all the Sensex run, yeah, the big bull run, the Harshad Mehta run. Then we had a new economy run in the form of technology. Then we had old economy in the like capital goods and Reliance and real estate. Then again pharmaceuticals, and then overtaken by HDFC and Bajaj twins. So the runs keep oscillating. You have to find your way in. This is an old economy run focusing on value. You have to be there. This $4 trillion to 10 trillion opportunity that India is in right now cannot be anything except a hold. Yeah. In betweens, the only thing would happen is that your betas of the portfolios, because it's a value run, would be higher. Try to control your betas, hedge your portfolios, stay in growth. This is an amazing run. I believe everybody needs to be in the stock market one way or the other, be it through AIFs, PMS, or the best way for the retail is to be in the mutual funds.
Yes.
Yeah, be invested in the Indian story, and no point to exit at all. If you are afraid, hedge a bit, and then if your portfolio falls less than what the market has fallen, then you will be under comfort, and that is what we are all looking for. कि जब टूटे तो हमारा उनसे कम टूटे, जब बढ़े तो हमारा उनसे थोड़ा सा ज़्यादा बढ़े. So yes, so absolutely I believe that except hold, there is no other option in the Indian markets right now.
So we have 3 holds. One is run, buy more.
Yeah.
Yeah. So we have, and I know the answer, but I want to hear.
So
from
if there is
you
an
again.
option to add more, I don't know.
Yeah,
You didn't know that?
please.
Yes, of course, of course. I didn't get that. So yes, absolutely keep doing your SIPs. It's very simple. Keep doing your SIPs whenever there is a fall. Like if you're doing 12 SIPs in a year, take a lump sum of 3 SIPs when the markets have fallen. Believe in the Indian markets. अभी तो काम शुरू हुआ है. अभी तो सड़कें बननी शुरू हुई हैं, right?
Right. True. But we are very skeptical, right? As a point, हमको इतने breaks मिले हैं ना बीच में से. So I think Aniruddha will answer his decade journey about the breaks, and what is your take on markets?
So I'm assuming that most of the investors who are there in this room, they are all I would say the long-term investors. I will take that option which he spoke at the end, which is it's a time to invest on India. The fact remains that if you look at where the world economy is, if you look beyond 6-7 years, and where India is in that overall, I would say the landmark, India is going to be the fastest growing economy by all averages. If you look at the last 4-5 years, the different headwinds which were there in the market, you can talk about interest rates going up, inflation going up, commodity prices going up, the raw material prices going up. On top of that, you had the elections which was to happen. Now, all those headwinds have become the tailwinds.
True.
Interest rates have peaked out, inflation has peaked out, raw material prices have declined, the margins have bottomed out. We had the election results, so which means the continuity of the government. On top of that, you have the world which is having roughly around 1.8 to 2.5% kind of a growth. Within that, you have India growing at 7 to 8%. Now, there is no reason why one should exit for sure. If your horizon is next 6, 7, 8 years, definitely it's a time to invest. The whole question comes that, as was mentioned, that there will be different sectors, different companies, different market caps which needs to be invested from the different investment time frame. So that will keep changing, but yes, it's a time to invest on India.
Yes, perfect. So I was reading when I was coming to Ahmedabad, there's a book called Happiness Advantage, and he said that we all take an average of input, but average people thinks average. The achievers thinks what is the pinnacle, right, and how I can perform. So, it's very, very interesting said that every decade change in market. So, last decade was a quality OPEX thing, and now it is CAPEX. How, because our theme is how we create alpha, and we are all here for alpha. What as a point of fund management strategy, or if you can say one, that can, that is promising to get the companies which are more value driven, less popular, and now in future it could be alpha. Like one of the best theme is PSUs, right? Nobody believed PSU 3 years back. Today PSU had given the highest returns in the portfolio. So at your PF fund, what is 1 or 2 things you see to create an alpha? What is distinct?
So I'll tell you 2 things, Rohan. One thing is that for creating alpha, you don't need to be ahead of the curve and try to be picking those stocks, which are going to go up 5x, 10x. there is also one other way of creating alpha, which is to avoid those sectors that are going to underperform.
Very well.
So I'll give you one example. You take Nifty. Nifty, the largest weight in Nifty today is banks and financial services, which is about 33 to 34% weight. Now I can take a bet and you compare any global index, developed market index. We are a developing world, we want to become a developed world eventually. So our index at some point in time will resemble the developed market index. So you take DAX Germany, CAC France, FTSE UK, S&P 500 US, all these indices over the last 15 years has seen a fall in the weightage of the financial services. In Germany, the industrials have taken up. In US, the technology has taken up. India is the only country where the financial weight in the index has gone up. So that is something that we need to ponder over. Now, there is this thing that in 2010, there are only 65 stocks in the investment universe of financial services. PSU banks, private sector banks, NBFCs and whatever. So in 2010, if I was an FII and I had to play financial services, the only option that I had was a handful of private sector banks and a handful of well managed NBFCs. But today in 2024, I can play in financial services, wealth management, low cost broking, high cost broking, health, life, non-life, depository, stock exchange and so on and so forth. So the non-lending component of financial services has increased to a point where the overall universe has increased from 65 stocks to about 130 stocks, which are having no presence in Nifty at this point in time. So when your Nifty is having a 33% weight in financial services, that is something that we need to ponder over. The second thing that we do in terms of trying to generate alpha is to track a lot of international companies. We don't necessarily invest in those international companies, but a lot of these Indian listed MNC subsidiaries, Kenna Metal, KSB, ESAB, Linde, Timken, all these companies, they seldom talk in India. But if you look at their global con call transcripts and what they say in their global annual reports, you get a lot of understanding about those companies. So if you take Pepsi for example, Pepsi always reports results about 7-8 trading days before Varun Beverages reports results in India, and Pepsi exclusively speaks about the volume growth in Asian markets and India. So that gives you a indication in terms of what is going to happen in Varun Beverages. Similarly, Whirlpool at one point in time reported very pathetic numbers. Global Whirlpool reported very pathetic numbers. Asia Pac was very bad, and 75% of Asia Pac was India basically. So it's the answer is in front of you. So if you're holding a Whirlpool stock, you just need to just run away, like you mentioned about running away point. Certain things you have to run away, and one thing is that when you track these global companies, you get a little bit of edge, is what is my humble opinion.
This is very interesting takeaway, that when you have an international company and when you start tracking, maybe it's the official way of seeing an insider.
Yeah, it's pure legal external trading.
External trading. And guys, this stocks are not for recommendation, these are for just an example. Yeah, perfect, sir.
So creating alpha, essentially markets, stocks move, they have two components of alpha creation. One, growth, earnings driven, and the second is what the stock will do in terms of PE expansion, the multiple expansion. We typically have been business cycle investors. So we try and invest when the cycles are at the low end and obviously exit when the cycles hit a peak. You're never going to time it, you're never going to get the low and the high. But as long as you've caught the trend and companies keep, they keep the faith. Most of these companies, when they actually get into a trend, they typically tend to outperform the trend, whatever the trend would be. And that is where the alpha is created, in our opinion. So some of the names which actually Vedana took, we actually owned one of those stocks, not the run one, so
honest enough to tell.
Yeah,
appreciate it.
Yeah, so that's that's how we do it. That's how we create alpha. So you try and time that, and it's not that you, of course a lot of people do that by buying into short cycle commodities. We don't do that, and that's because that's even more difficult to actually anticipate and time. We actually try and pick out some of the longer cycle plays and try and play that to create the alpha.
Great.
I think I am the odd one out here. So for me, I believe that the stock markets, the money is only chasing growth. So this is the fundamental of the entire algo universe, or whatever we want to call it, at Invasset. So what I believe is that as stock market, it is just oscillating between valuations and relative change. So by relative change, I mean that something that was not available to the company in the past, that is available now. For example, when COVID came, COVID was itself a big relative change. The problem had to be solved either through medical intervention, and to cope along with it, you needed technology. Yeah, so relative change was very, very clear during COVID. Similarly, when we are in an old economy run, when the new economy run that COVID had presented, it changed because the valuations of IT and pharma, especially IT companies, it's reached the value, with the growth of 12-13% and valuations going off the roof, it was very, very clear that it is not sustainable. So after that, in an old economy run, you had only two things: either interest rate sensitives would perform, or I would say, the capex and capex theme oriented themes would perform. Government taking with a clear intention, bringing in GST, then amending the tax laws, direct tax laws, indirect tax laws, RBI stepping it in time. The intention was clear that they are going towards capex. It is firstly the duty of the government to go in for the capex. And then from 2,50,000 crores in 2013 to 11,000 crores, this entire thing had to be, absorbed. So there was no other theme that was there in the market except all these railways, defense, infrastructure and power. These are the prime beneficiaries of capex. So we have been holding them for 2 years. If we talk about the future, this is the past. If we talk about the future, another major relative change that is happening in market is that the Fed has now clearly said that inflation is not a problem for us anymore. Okay, when the rate cut will come, it's just an event for the retail. The markets, they start discounting in the future in the year very, very soon. They're very, very quick. The markets don't wait. It is full of intelligent people, and they'll discount what is going to happen in the future very, very soon. So I believe that the metal prices, especially the metal prices going forward, from the squeeze that they have had. There was one time back in January when the Indian scrap prices were so so uncompetitive that there was an extreme shortage of scrap in India. So we have bounced from there. 50% of so from where I come from, Ludhiana, there's a very big I would say steel manufacturing city there called Mandi Gobindgarh. 50% of the mills there were for sale. Yeah. So when you bounce from that, then you see a tremendous upcycle in metals. So I believe metal prices to go up, and then all those consumers of metals who are not easily able to pass their metal prices to the customers. For example, autos currently today at very, very high valuations, now seeing a relative change in the form of that the metal price is going up. So this is something that you have to correlate over the time, and if you are able to do so, I think you should, for me, I believe you should participate in everything. If you have not participated in the technology run of 2000, or you have not participated you have to participate in every run. I think be agile, be very, very, you should know the shortcomings of everything. So you have to plan your what percentage, what weightage you have to give. But I believe to generate alpha over the over the index returns, it's very, very difficult. But to do that, you have to participate in every run, every relative change that is out there. Just be very, very agile on what the relative change is. And if you are participating it, before knowing the upside, you should know what the downside risks are. If the downside risks are clear to you, you can surely make very good on the upside.
Perfect.
I think alpha creation is kind of something which everyone wants. If I go back in history and see the way the markets work, I think one thing which is very common among all of us, and I would say that happens for every investor also, ultimately the market, it follows the business cycles. I have been a very strong believer of that. Our philosophy and strategy, it revolves around that. So the whole investment philosophy which I follow is called sector rotation. Idea is very simple in the layman terms. Be there in the right sector at the right time. It's very easy to say, very difficult to implement. But I would say that if 70-75% of the times you get your sector selections right, I think that adds a big percentage to your alpha creation.
True.
But that doesn't, I would say, decrease the whole effort of doing a bottom-up analysis. You can be in the right sector, but you own the worst company. you will not have any alpha. So I would say you have to balance out your both sector selection, and then is the difficult part of picking up the best company in that sector. So I would say that alpha creation, what we do is sector rotation is a investment style. It follows the business cycle, which leads to the earnings cycle, which leads to the valuation cycle. At the bottom of the business cycle, your earnings are the weakest, valuations are the most attractive. That is the time you will find least number of investors, they want to invest into that particular industry. Now you spoke about the government companies. So PSUs was the hated, whole pack of PSUs was a hated basket prior to the COVID. Completely it has changed. So business cycle leads to earnings cycle, it leads to the valuation cycle. At the peak of the business cycle, earnings are the best, ROEs, margins, everything is the best, valuations are over the roof. So one part of sector rotation is be there in the right sector, right time. Much more important than that, I think you mentioned, is being out of the sector when the valuations are rich. So sector rotation is all about being in, also being out of the sector. I'll just give you a small glimpse. For the first 2 years of COVID, so 2020, 2021, almost 65% of my portfolio was pharma, the chemicals, IT and FMCG.
Right.
65% was that. Now if I go back and see, these were the sectors which were doing exceptionally well during that period. From somewhere in the middle of 22, all these 4 sectors, they started decreasing the allocation in my portfolio. From 65%, the combined weightage for these 4 sectors, it went down to around 11 to 12%. All this money moved into urban consumption, industrials and capex and the government companies. Also the other financial services, like he mentioned about asset management, insurance, housing finance. So that is very important with regard to the one part. Second part is about balancing the value and the growth style. I think if I look at the last 8 quarters, out of the last 8 quarters, 6 quarters value and the momentum has done well. So that becomes very important that you are there in the right part of the market, because you should balance, like as he mentioned rightly, you have to be there everywhere, but you have to identify when to be in value and when to be in the growth part of it. So this is, I would say, the whole thought process around what we try to focus in building the alpha in the portfolio.
We'll take some questions after certain questions which I asked. But before it, because I know my Gujarati audience very well over here, and we cannot talk about stocks, right? So if you want to answer that something, which right now you feel as a fund house, a sector where you are overweight and you feel that's a futuristic point, and certain sectors which you feel that these are some things which we like to avoid to create alpha. We can start from you, because every time I don't want to give you at the end, right? So if you can, it's subjective. If you don't want to answer, that's still okay.
No, like I think with regard to the sectors where we are bullish on, I think that's very interesting part, because that is what we do. Perfect. So I would say that for the last 18 months, I've been very bullish on urban consumption, industrials and capex. Many investors, they asked me around the election time after the results were announced that, do you plan to change your sectoral allocation? I don't see a reason to change. So I would say I'll continue to be bullish on urban consumption and industrials and capex. The reason for that is that urban consumption is one part where we have seen a lot of the resilience with regard to the income growth and the demand factor. Now what comes under urban consumption? Basically, if I look at where do all of us, we spend our money. So within the urban consumption, one is your auto and auto ancillary. Second is your hospitality, which is hotels. I think hotels have done exceptionally well. The third part is the real estate and ancillaries, and the fourth part is the consumer discretionary. There are companies like Tata, Trent and the Zomatos of the world. So this makes up your urban consumption. The second major sectoral allocation is your industrials and capex, where I would say we are in a multi-year upcycle. Valuations of some companies could be very rich, but I think we have to look beyond the next 1 year, because that is going to be a massive transformation. So when I talk about industrials and capex, you will have your capital goods and engineering companies, your power EPC business, because power is a sector I am very bullish on.
You have told too many sectors. I want one from you.
So right? I will say industrials and capex, wherein power EPC is going to be a massive sector, wherein you will find a lot of capex from the government.
And somewhere you have been underweight, or you've not been?
No. So I've been overweight on power EPC.
Underweight. I'm telling you.
Underweight. Yeah. Okay. So sectors which have been underweight, IT.
IT.
So index has 14-15% IT. For if I look at the last 6 quarters, for almost 4 quarters, I didn't have a single IT stock in my portfolio.
Oh, fantastic.
So that actually gives you a glimpse of the sector rotation I do. Index has 15. I don't want to hug the benchmark. I don't have a single IT because I had my own issues.
Very fair, sir.
I think our portfolios and psychology are more or less the same.
Our names also same.
Yeah,
And you guys both are sitting also, so it's very confusing for a moderator to speak on both.
So I think yes, the trend is very, very clear. So capex is the theme of this bull run, and rightly so. A lot of capex work needs to be done in India. To support India going from this $4 to $10 trillion, capex is the only way forward. And thank God, not going in politically, but thank God we have a government who's thinking somewhat in the same direction. So capex is one. So with capex come all the 4 capex beneficiaries: railways, infrastructure, powers, and defense. And then he's putting in terms of urban consumption. I put it in terms of premiumization. That as the income of the Indian consumer is increasing, you will go in for premiumization. Buying a 10,000 ticket from Mumbai to Delhi 10 years ago was like you used to think twice. Today you don't think. Everybody is doing it. I think consumption is very, very relative. We are a group of 5 people. We are all going in our Maruti Suzukis, and then 2 of them buy a Mercedes Benz, and then other 3 would be like, "Hame bhi lena chahiye yaar." So this is what fuels.
There's something in between also.
Okay, I was just giving an example. So everybody is like this. Okay, it's very, very relative. So India, not only India, I think the entire world post-COVID is going through a premiumization drive. So luxury real estate is one for us. I believe I have a little bit skepticism about autos, because we feel that after the inflation is controlled, there might be a lot of increase in the metal prices, and only those people who will be able to pass on the metal prices very, very easily. For example, if I'm selling you a 5 crore rupees flat, I'm not concerned ke sariya kitne ka aaya, right? So we believe that they will be better bets, and if we have seen it everywhere, 1990s in the US, then in China in the early 2000s. Today we are seeing it in India. This I'm mentioning it again and again, that $4 trillion to $10 trillion run. A lot of traction you see in real estate as well, because house for us, I believe, house for everybody in India or wherever is a basic necessity, and everybody, I believe, would go crazy after owning a house in the very near future. I've seen people in Gurgaon where they've earned, worked wonderfully in very, very good companies, earned throughout their life, made a corpus saving of 5 crore rupees, and when they were living in those houses which the companies had provided them, and today when they retired and went out to buy a house, that house is costing them 5 crore rupees.
True.
Yeah, so everybody, the new generation is like, let's buy it soon. So I believe that real estate
which
should
is the sector you would be downgrade on auto or skeptical on auto?
I do not have anything in FMCG, pharma, IT,
Perfect.
quality lenders, nothing, zero.
Zero. Amazing. That day everybody thought that FMCG will turn around, but again,
Yes,
yeah,
no.
if you remember that day.
The valuations are pretty high for us.
True.
Yeah.
Arun?
So they've said everything.
They said everything.
So I
कुछ अलग,
कुछ अलग,
something,
हाँ, ठीक है.
something.
तो नहीं कुछ एक तो सिमिलरिटी बोल देता हूँ. I also call it premiumization. I don't call it urban consumption.
Yeah.
So premiumization is one of our themes. Covers a gamut of sectors from autos to real estate, hospitality, all of that. We too are extremely bullish on the infra space, capex. So that's we've not. So June, that particular day, what you're talking about, we had a different view, and it kind of worked.
Yes.
So we didn't make the mistake of getting into FMCG. But having said that, FMCG are good companies, but
Totally.
obviously growth is missing, except the one company which I've already named. That's the one which we have invested in the FMCG space. So we are underweight FMCG, we are underweight IT, the same usual stuff. We are actually quite significantly underweight financials too. Mostly our investments are in the non-lending space, not in the lending space. And I don't see any reason to actually move out from these themes for the moment. So we've kind of tweaked our portfolio, and that is what we think should work for some time. What else is there? I mean, there's nothing else new actually other than this which I can think of. Yeah, while it's working, jo chal raha hai, chalne do.
So I'll tell you, we meet so many management, and the biggest concern is that they don't get planes. private jet has 5 years of now waiting period, and they've made so much money. Now they are thinking that I need private jet, right? And say हाँ पैसा है तो and they say that don't कुछ connect हो आपकी कोई company में investment हो तो, but they don't get private jet. Previously I think so 5-6 years back people wanted to sell their private jets, and that's the biggest trend change which has happened.
So I track a lot of world indices, and I track the constituents of sectors and everything in those indices, including the Indian indices, but in my portfolio I never track my sector. So it's, for me it's a little difficult to answer, but having said that, usually fund managers, you know, they have this tendency to say that short term cautious, long term positive. That's a very safe answer. So I'm going to give a slightly different answer. Short term positive, long term negative for me is private sector banks basically.
Okay.
And another way that I look at things is that, of course my friends called here premiumization, so I define it slightly differently. So you have a 7.5% of real GDP growth, and then you add 5.5% of inflation, so you have about 12-13% of nominal GDP. So your country is growing at 13, which means that there are industries growing above 13, there are industries growing below 13, and invariably you can find answers as to why something is going above nominal GDP, something is growing below nominal GDP. From a $800 per capita in 2008 to a $2,500 per capita today, Indians have become richer. So आदमी जब अमीर होता है, so the habits change in terms of consuming products and services. Women participate more in the labor force. Then what happens to the kitchen, the utensils that are used in the kitchen, the kind of food that is being consumed in the household, these things see a significant amount of change. So I will give you some examples, right? So today your MDF as a category is growing at about 400 basis points more than nominal GDP, but it is coming at the cost of plywood, which is probably growing at 400 basis points less than the nominal GDP. Your SUV and mini SUV is growing 200-300 basis points more than the auto industry growth, whereas the hatchback is growing probably lesser. Similarly, this happens within the companies also, like KEI grew at the cost of Finolex, market share gain. Safari Industries grew at the cost of VIP Industries, again market share gain, and you know, CPVC and PVC players grew at the cost of galvanized iron and copper players. So I think the delta and alpha or gamma, whatever you call it, it remains in these type of stories where, you know, when you are able to capture that market share gain. So we continue to be quite constructive on these type of stories, and what we do now is we very religiously track the BIS, Bureau of Indian Standards. This body has been given a lot of teeth. So the last company I met was a company called Poppies in Calicut, and the promoter was mentioning, Balaji, now there is no way that you can import a diaper into India. So diaper आपको India में बनाना पड़ता है. Similarly, Amritanjan, which has never ever done capex, has announced a 100 crore capex because they were getting comfy sanitary napkins from somebody else. Now they want to do their own manufacturing. So these are all certain structural shifts which are happening at micro level, and that gives hope that despite the optically high 23,500 Nifty and all that, there are still a lot of stories. I mean, one last example I will give you. Value added dairy. I come from South India, and South Indian households, till my grandmother was alive, you buy milk from the store and you bring it home, it was a blasphemy. I mean, like, how can you buy milk from outside? We'll make curd from outside, we'll make curd at home. Curd, lassi, buttermilk, everything was made at home. So now with the virtue of women participation in the labor force going up, value added products are growing greater than GDP. True. So a typical dairy company which used to sell milk is a commodity, you are not a price maker, you are a price taker. From that you invest a little bit in logistics and distribution, put your own chapa and build these brands, suddenly your pricing power gets a little better. So from a commodity like valuation, you end up becoming a slightly semi FMCG like valuation. So not only do you get the multiple expansion, you also get the earnings growth. So this happens when you keep tracking the consumer behavior over a point of time.
Very interesting. So we have 14 minutes and we have many questions today. So we believe that in any PMS, AIF, again in long fund, there are three things that are very important, which is selection of a stock, allocation of a stock, and review of a stock. Most of the people emphasize on how you select a stock, very few emphasis on how much you are allocating, and rarest put out on how you are reviewing a stock when you bought it. What do you feel that of these three things it's very important at your end, and how you do it? If you have a practical example to share with one of an example or anything, if your past experience, we can start with Arun because you have been in the middle side of it.
So are suiting your investment thesis. The day the investment thesis goes kaput or some of the parameters like margins and ROC start to peak, then you actually start to reconsider your investment. So that would be the review, and of course the review also would be in the sense that if the allocation has increased beyond the levels at which you can manage the risk, then you start to actually trim it to some extent. So it's very difficult to actually therefore say that which particular parameter is more important than the other. Each one is important, but that's the general pattern.
So adding up to this, this is a question. So now there's a biggest conspiracy is that private bankers versus PSUs, and certainly a lot of people have been invested in certain 2-3 private banks, and they have been like 25-30% underperforming to Nifty 500 or BSE 500. Now in this type of situation, if you're holding a great company, it's a great company, reviewing is a very important part. So now as a fund manager, what do you see that, okay, fine, it's not performing to my thesis, or okay, let me be practical and move it to the things which are performing. What do you see as an individual or a fund manager? We can start with you because it's a joining question to this.
So I actually forgot the question, but because you kept on saying financials, so I'll probably go to get the financials.
So my question was that a very popular private banks.
Yeah. Okay. Yeah. So our house view is that like we don't like lenders as such. Within that space, we have traditionally preferred the private banks. So to that extent, we have missed out on the PSUs. But that doesn't mean that we have to sell a private bank and get into a PSU bank. We might as well sell the private bank and invest somewhere else where we are more comfortable. That's what we could probably say that what we have done. So that's probably would be our approach. We really don't. It doesn't really matter what the market is saying. You have to have belief in that.
Perfect. Makes sense. So there are my two questions. One is allocation, selection, allocation, and review, and any other. So private bank versus PSU is just an example. We can also take a chemical versus a pharma or something like, because it was very popular a decade, 3 years back, and now there's no points of outperformance.
Yeah. So I think all the three stages are very, very important. Firstly, when you come to selection. So when the selection stage starts, the biggest problem that is out there is bias. We as humans, we have a tendency to go into the comfort zone from time to time.
True.
You leave us somewhere, we will enter the comfort zone. Okay. So that comfort zone needs to be broken. If something is anti your psychology and the other person is doing well, try to learn. Yeah. So first of all, break out of the comfort zone. The biases that you create over time with sometimes that you have been shaped, sometimes with what commitments you have given to your investors, with sometimes what commitments you have given to yourself, that you need to change over time. You cannot be fixed. This is a very, very dynamic market. India is a very multifaceted market. You have everything from old economy to new. You have something like a TCS and you have something like a Tata Steel.
True.
Yeah. So we are blessed that way. So selection is very, very important. I believe. Why? Because you have to overcome your biases there. Yeah. Then allocation. This was something that was taught to all of us by the great late Mr. Rakesh Junjunwala.
100%.
कि मिलेगा नहीं, और अगर मिल गया और उस टाइम पे बड़ा नहीं किया तो बॉस आपसे, I would use to say, आपसे बड़ा गधा कौन होगा. So एक बार आपको वो मिल गया, you know that you have found the right thing. It is your duty to make it big. Yeah, make it very, very big. Make it count. And thirdly, the most important phase is analyzing. आपको कुछ बड़ा मिला, आपने उसमें पैसा भी लगाया, but आपने 400 पे लिया और 800 पे बेच दिया. Then how will you, what is the point of looking at something like a Unitech went from 1 rupee to 400 rupees, or something like a Infosys went up, or why do we even chat about what happened during the tech boom? Yeah. So if you have to analyze them. You need to know that markets are not always prudent. Yeah. Neither they're prudent on the downside, they're not prudent on the upside as well. In the downside, they'll turn wonderful companies to dust, and on the upside, they may turn them into diamonds. So this dust to diamond scenario, you need to know what cycle you are in. कि कब market is only when it is doing PE expansion, when it is doing earnings expansion, and when it is playing satta. Yeah, so all these three things I think should be very, very visible to you. You should have that knack, and all these three stages are very, very important. And how we counter this is we start looking for the next change. When you get the next change, it is easier for you to dispose. आप पिछले स्टॉक के साथ क्यों रहोगे? आप इसलिए रहोगे कि आपको क्या, मैं पैसे को किधर लेके जाऊं? या अब मेरा पैसा है, बढ़ गया है, मैं किधर लेके जाऊं इसको? If you look for the next opportunity and you are able to spot it, you are like, okay, भाई थोड़ा पैसा इधर दे. Yeah. So continuously keep looking for the relative change, and then you will not be caught in that trap, because automatically as the things get expensive, you will start allocating your money to the next best possible opportunity that is out there. We keep on doing that from time to time. We may be wrong, but yeah, it has served us well over time.
Aniruddha, your transition from, and I can relate it, we would have said stories about great qualities over the period of time, and one fine day we say that no, now the things are changing. How do you see it, and how swiftly you do it?
See, one thing which I've seen over the last, I would say 18 years, is that the time which the cycles have taken has decreased drastically.
True.
There was a time when it used to take 6, 7, 8 years for the cycle to play out. That has changed drastically. I would say that's also to do with the amount of capital which is available in the whole economy across the globe. So I would say the cycles have decreased, but I would say that very frequently also one should not keep jumping from here to there. So it takes some time, like you have to analyze multiple parameters, look at the inflection points, and only then you have to enter. Just to add to the points which we just discussed, I would say on the selection, allocation, and that, one thing which I've observed, and I keep saying this to all investors, that there's a disproportionate amount of time which the whole investment world, I would say the business channels, business newspapers, different workshops, disproportionate amount of time gets spent on focusing on just the first part, which is the selection.
Yes.
The least time is spent on allocation.
True.
If you look at your portfolio, like I'm sure you would have heard so many people, I've bought a company A has gone up 8x. Then you ask that guy, in that case, you would have made a huge amount of money. So he'll say, the amount was extremely small. So allocation is very, very important. So if you have spent decent amount of time in evaluating a company, it has become your high conviction bet. You begin with a small allocation, but as you move on every quarter, you get more comfortable with the management, with their earnings growth, with their execution. That allocation has to improve significantly on your high conviction bets, decrease significantly on the low conviction bets.
True.
If I look at my portfolio, the top 6-7 stocks makes up almost 45% of the entire weight.
Perfect.
That is very important, that your highest bets should be your highest conviction ideas. And I would say the review part is equally important, because typically, as he mentioned rightly, investment bias happens. Investment bias happens both if you make profit and if you make loss. If you make loss, typically 90% investors, they avoid booking a loss. If you make profit, it happens ki it's making profit. If I exit, I'll not participate on the upside from there. So I think that is a very ongoing process of taking a review of your portfolio companies.
As it is said, it's not what you buy, but it's how much you buy.
Absolutely.
And we get portfolios, they're 1% of that stock or 0.50% in the portfolio, it takes 20 times higher than your portfolio is impacted only 10%, right? So people say, हाँ मेरे पास है, but if it is 1% or 0.50%, eventually you're just playing that. If you want to add anything on this?
Yeah, so to me, as an active fund manager, I can commit two types of errors, error of commission and error of omission. Error of commission is I buy a stock and then the stock falls 30-40% due to corporate governance or whatever be the issue. That is error of commission. Error of omission is I look at a stock, or for some reason I don't buy the stock and it goes on to become the next Amazon. That is error of omission. So as a fund manager, what keeps me awake at night is error of omission, not error of commission. I'll tell you why. PMS is synonymous with concentration. I shamelessly agree that I am not a big concentration fan. I have about 37 to 38 stocks in my portfolio, and I like my comfort of so many names because I don't want to make the mistake of omission. So to me, allocation becomes a priority in the sense that on day one, nobody knows that it's going to be a multi-bagger. So to that extent, I concur with Mr. Aniruddha that you seldom do I buy a stock which becomes a top weight in the portfolio on day one. So you start off with a tail weight, and then you see whether management undercommits and outperforms, or whether they overcommit and underperform, and accordingly, based on execution, I mean, if it's going to be a long runway, you don't need to capture the entire 100x or 50x or whatever it is. So you can still get your comfort. So the conviction on a stock on day one is very different from your conviction on a stock on day 300. So accordingly, you can ramp up as you go forward. So typically the journey of a stock, a winning stock in my portfolio is, it starts in the tail, and then by virtue of me adding more and market action, it goes to the top of the portfolio. So I like my diversification, and if you are my view is that if you are a very concentrated investor and you are very comfortable with your concentration, go ahead by all means. And if you are a very risk averse investor, you like a diversification, go ahead with all means. But if you are a cat in the wall investor who has a long stock, long list, but you don't know whether you are doing the right thing or the wrong thing, let me tell you that BSE small cap index, any idea how many number of constants are there in the BSE small cap index? Any guesses? BSE small cap index has 947 stocks.
Yes.
And the 10-year return of BSE small cap index is 18%. NSE midcap 150, as the name says, it has 150 stocks. There are 60 stocks in the NSE midcap 150 which has beaten NSE midcap 150. So matlab aapka 40% of the index constants are beating the index, that is percentage wise. But if you look at the absolute number, there are 60 stocks that are beating. So why are you tying your hands and saying that depth, I will do only depth? So my portfolio is a good mix of depth and breadth. So there are some stocks where I apply depth, and there are some stocks where I apply breadth.
Very interesting. We have any questions from the audience? If we have, I have many. So I wanted to give anybody wants to ask? Yes, sir. Gentleman from maroon shirt.
Parvat this side. So basically, I am a investment person from Surat. One question is regarding that you all are bullish on premiumization of psychology right now of the common people in this country. There is one statement from the person, probably the CEO of Mercedes-Benz a few years ago, that the biggest competitors in India for me is not the other luxury brand, it is mutual fund. So this describes the psychology of common people in this country. I don't say common people, but the people of this country. So what is the timeline you will say कि इतने टाइम के अंदर ये साइकोलॉजी चेंज हो जाएगी, हम प्रीमियमाइजेशन की तरफ जाएंगे, ज़्यादा हम ये इन्वेस्टमेंट सेविंग्स वाले पे नहीं देखेंगे, या फिर हम 100% चेंज नहीं होंगे, थोड़ा बहुत चेंज होंगे, लेकिन the DNA will be the same?
So I think it's a combination. It will always be like this. Whenever there is, I would say, an old economy run, or you can say an investment run, India being more traditionally inclined towards the own economy where the asset prices go up. Asset prices ke upar jaane se, your consumption power increases. And I think they are two different concepts altogether. Mercedes-Benz CEO saying that my competitor is mutual funds, I believe is not the right statement. Yeah, it is just because he was thinking that the money that is going to the mutual fund should come to his Benz. Yeah, but ultimately, I believe we are all in the very first stage. We are just started getting rich, and Indians का तो simple है, पैसे कमाओगे तो खर्चेंगे, and so I think it is the mutual funds which will ultimately propel people to buy the Mercedes-Benz that he is here to sell. So I think India is going through this wonderful drive through what SEBI has. I think we should all compliment SEBI for 100%. What they have done for the Indian investor. हम लोग सब FD वाले लोग थे, yeah, and हर साल अपने पैसे का जो परचेजिंग पावर पैरिटी है उसको कम करते थे, 4-5% का इन्फ्लेशन, और फिर टैक्स के बाद 3-3.5% का रिटर्न, और 1-1.5 साल हर साल कुछ ना कुछ हम कम करते थे. So I think mutual funds are, I'm taking it into a different direction altogether, but yes, I believe that the best thing that is happening in the Indian markets right now, in India as a country right now, is the extreme trust that the Indian public now have in the mutual funds and the financial products. We are getting away from old products like gold. I believe somewhat from real estate as well. We're getting 21,000 crores of SIP every month, right? That is
Crazy.
massive. And I believe it has just started. We'll see much more into the coming years. Yes, and this is what will fuel the sales of all these BMWs and Range Rovers and whatever. So I think, again, coming to the point to sum it up, that Pele, you have, if you're a salaried person, I was talking to if you're a salaried person, first thing is if your salary increases, your lifestyle goes up. You become rich and spend in super luxuries only when you have assets. So India investing in assets, I believe, is a very good thing.
So just to add to that point, it might help others also. I would say that the whole thought process why all of us are so bullish on this whole the consumption thing is what you consume changes drastically as the per capita income of the whole country it evolves. Now what typically a consumer would be buying when his per capita income $1,500 is very different. In fact, there's a very interesting data that when your per capita income is below 1,500, almost 65 to 75% of your wealth goes into buying the basic amenities. And as your per capita income evolves and goes beyond $6,000, that whole basic amenity is just around 18 to 20% of what you are going to spend. The rest, 75 to 80% goes in your all these other activities. So that is the main factor why I would say consumption is going to be a big growth driver.
We have a question from this gentleman.
Hello sir, Parthavia from Tracom Stockbrokers. Thank you for taking my question. So as it is very wisely said that you take care of your downside or the risk and the upside will take care of itself. I would really appreciate if all the esteemed panelists would just give one or two risk factors that they are envisaging, or things like self-goal implicit decision making could kind of devalue the Indian markets. Thank you.
So there are some areas where the valuations have kind of, the narrative has kind of overtaken the numbers, right? So you have a situation where the narratives and numbers work together, then you have a significant wealth creation that is sustainable. But in certain cases, the narratives overtake the numbers. So there are certain pockets like defense, etc., where there seems to be a bit of narrative that has kind of overtaken the numbers. So you could see a bit of I don't know, maybe because at the end of the day the customer is still the government, and some of the payment cycles, etc., is kind of still not giving. So if defense were to be like a multi-year opportunity, it's not necessary that you have to capture the first cycle itself. There are going to be multiple cycles in which you can play till the time you establish certain rules that kind of play out. So that is one pocket where I am kind of a little uncomfortable with at this point in time. So it's going to be a very what do I say, sector rotation kind of a thing which we have been speaking about, right? So there are broadly two types of correction, Partha. One is that you get a solid 15-20% lower circuit 2 days on COVID or great financial crisis. Actually that correction is far better because it is invariably followed by an extremely high amount of buying. There is a bit of a bottom that is formed, and then world moves on. The second type of correction is a grinding correction, where for 4 years, a basket of stocks don't perform, the neighbor is getting rich, but your portfolio is not doing well, so your 100 remains 100, FD may 100 would have become 118, all those things after 3 years, it starts playing out basically. So I would say the risk is more on the certain sectors rather than trying to give a very holistic thing, because the world over the last 15 years has seen extremely tumultuous circumstances, including a pandemic and wars and PIGS crisis, MENA crisis, demonetization, GST, multiple elections, and in fact after COVID we had two more issues, like we had the Russia-Ukraine war, but market just brushed it off. All we got was a 12-month time correction. We had the Silicon Valley Bank crisis, the regional banks in the US kind of didn't do well, and market brushed it off. So it has to be extremely sector and stock specific, because the global correlations doesn't seem to be working. I know people were thumping the table and saying that when interest rates are at 0%, therefore cryptocurrencies are in a bubble. Let the interest rates go up and see everything is going to come down to zero. Zero say abhi kitna ho gaya 10-year US ka 4.5% or whatever.
5, yeah.
And Bitcoin is at what? $70,000. So that simplistic kind of correlations have all kind of broken down. So it has to be extremely micro level and stock and sector level in terms of your risk. And one way of overcoming, which I do, is to have a lengthy stock list in my portfolio.
So you don't miss out. So if you want to add?
First of all, the risk valuations obviously is the key risk here at this point in time. But having said that, what else can bring the market down? I mean, obviously, unexpected things we can never talk about. If you ask me what is the immediate risk, is what market is looking for in the budget. We really don't, nobody really knows, nobody's talking about it. There are some expectations that, you know, we saw this run up in all these fertilizer companies and all last week. So there are obviously some expectations that rural spending will increase, and for some reason it will start to benefit all these companies. So those are the kind of things which I think would probably becoming a kind of a, I want to call it a macro risk, but it's a kind of a short-term risk for the markets, because clearly there are several pockets which are expensive. One of them which Balaji pointed out, but to manage risks, you will have to look for, you have to basically continue to invest in companies or invest in PMSs or AIFs wherever you so desire, in which you are, you can understand well. I mean, don't get into newer areas just because the market is suggesting you should go there. That would probably be the biggest risk in my opinion.
We can take one more. You want to add?
Can I add one more point?
Sorry, please, please.
So I'll add one more point, right? So the broad thing is that all these, you have these, suddenly one Gyani from the US comes and says like Dow is going to fall like 30%, US market is going to crash.
The biggest recession in 2025.
90. Somebody said 90, Harvey Dent or something.
2000. There was a Money Control article where somebody wrote that 2025 is the biggest market crash.
Yeah. So I saw the 30% number. So I just want to ask him, you tell me US market, okay, there are three main indices, NASDAQ, S&P 500 and Russell 2000. NASDAQ is your IT index, S&P 500 is a broad-based index, Russell 2000 is a mid and small cap kind of index in the US. Take the 10-year return, all in dollar terms. NASDAQ has given 20% return, S&P 500 has given 10% return, and Russell 2000 has given 5% return. Russell 2000 has underperformed Japan, and we all thought Japan is a dead duck. S&P 500 has given 10% return because of the virtue of the top 10 stocks in NASDAQ, which is also part of S&P 500. So our topmost stock in Nifty 50 Reliance Industries is a $250 billion market cap. Usko leke agar aap, if you put it in NASDAQ, it will be the 14th stock. So the top 8 guys, 10 guys are in a different orbit. Nifty entire market, the PAT of Nifty is about 7,85,000 crores. Microsoft PAT is 7,85,000 crores. Google PAT is 7,40,000 crores. So suddenly these guys allocate $10 billion to artificial intelligence or whatever the market doesn't like. So these guys fall 10, 20, 30%, and the next quarter they make up the $10 billion cash flow, and then again it moves up. So we have to be very sure what is going to fall, whether FANG fall or overall market fall. Overall market fall, aapko BMW is at 5 PE, Mercedes is at 5 PE. Are we saying that it's going to?
Tesla is at.
So I think it's going to be a very segmented kind of approach. FANG can fall, no two ways about it. But overall US falling, I don't think that's not.
Nvidia is now 450 shares of Nifty 500 is equal to Nvidia's market cap. So yeah, that's what we are seeing. It was 10 years back 53x lesser than Apple, and today it is bigger than Apple. So anything and everything is possible in this world. We can take last question and then we can end. Yeah, please.
Good afternoon, gentlemen. I wanted to ask you that with this whole advent of global warming, the world is going towards carbon neutral, and there has been a lot of focus on green energy and renewable energy and stuff like that. So I wanted to ask you that how can, like, as far as Indian markets are concerned, how can we play that theme, because the world is really going very big on that whole spectrum, So like as far as Indian markets are concerned, how can we basically play that theme?
I think this whole concept of the ESG, which is there, where you're trying to focus on the renewable energy. Unfortunately, in India, unlike the West, you don't have many. I would say the listed companies. You have a couple of them which are completely focusing on that, but you don't have many companies there. But having said that, I would say every company who's there in that energy space, they are doing some investments into that basket. So as of now, very few people know that NTPC, like when you talk about NTPC, typically the thought comes that it's into the thermal power. It happens to be the largest solar power also in India. Similarly for Tata Power, we know that they are into thermal, but they are also the second largest into your solar. You have your other names like your Suzlons of the world and your Adani Power and all that. But I think valuation is a very big factor wherein you need to keep in mind that how much of the future earnings is into the price. Having said that, I think as of now you have a couple of names, as I mentioned about these names, which are investing into that part of the business. As of now, they are contributing a very small part in their overall earnings, but as over time, I think that percentage will increase for all these companies.
Okay, and sorry, just a sub question.
Okay.
Is that okay? Yeah, because sir, for example, like when the whole world is really pinning on EVs, we have some very interesting synergy which is playing out in India in terms of CNG also, which apparently Bajaj is very big on that, and Bajaj will be soon launching its first CNG-based motorcycle.
Right.
So, I mean, it's I think, a lot of interesting synergies which are happening in Indian markets as well, which is not very apparent to the eye. So, there's a lot of stuff. I think we are literally at the brink of explosion. That's just, I wanted to add on. Thank you.
Thank you, ma'am. We will have last question from gentlemen, and then we will end the conversation.
So my question is to Mr. Sarkar and Mr. Garg. So as you have mentioned, you are bullish on IT sector. So my question is contrary to that. Like I just wanted to know your opinion on the latest new age IT companies like LatentView or Datamatics or something like that, who are into AI or data analytics. And secondly, as you mentioned, this IT companies' businesses are more dependent on our external environments, but our government is biggest customer nowadays. They are revamping their existing portals, as well as Mr. Modi mentioned, he is involving technology into everything, every initiative he is taking. So, is there anything we can see in the traditional companies which have a good track record, and they are going to get those big orders from government? So, I just wanted to know your opinion on this aspect.
Okay.
So I'll just mention on that being negative on IT. So I have been negative on IT for the last 6 quarters, but as of now, I think the valuation and the opportunity which is opening up gradually, I think it's a time to start looking at some of the IT companies. Having said that, I think the names which you mentioned, many of those are doing well because they are not purely the, I would say the Indian IT which used to be, which is all about outsourcing. They are also into very different areas which is seeing a very high growth. Like many of these IT companies are working with the defense companies. Some of them are working on AI, as you mentioned. So I think it's a good time to start looking at IT companies, but don't make a mistake of getting into an IT company just because it's the hot sector. Because I've seen some companies, they are quoting at 70, 80 PE just because they are into the hot sector. They are into IT, but they're catering to customers which are there in the hot sector. I think that is a very big avoid for me. Having said that, I think what you're going to see is with the rate cycle kind of going down, discretionary IT budgets will increase outside India also. And as you rightly mentioned, I think government is also doing a lot of automation in different parts of its ministries. I think domestically also many of the IT companies are seeing demand coming back.
Yeah. So how I see it is that Indian IT, I am just spotting relative change every time. What was relative change that I mentioned? That something that was not available with the company earlier is now available, like a tailwind. I believe if we look at the globe, top IT companies throughout the globe, okay, the American companies are here, then some some Asian companies, and then come the Indian companies. Indian companies are not, first of all, we lack innovation. I would say a serious there is serious lack of innovation in India. Our spends on innovation are not much. I do not see the next NVIDIA coming out of India. Yeah, if I'll see the next NVIDIA or something like that, where relative change, where they'll produce something very, very different. Yeah, they'll change the way a business is done or perceived, then I'll surely, would be one of the first buyers in those. But when we talk about IT, we are generally talking about companies like TCS, Infosys, and sometimes mid-cap IT also now. They're not doing anything new here. So, of course, the few companies that you mentioned are, progressing in that field. But generally, when we are talking about IT, we are of the perception that, okay, so we had bought an IT company back 2 years back, which was into automobile design. Yeah. So that is a company which is doing something new. It is like it has a total business model in which in the business model there is a full, I would say, segment that is focusing on how EVs can be created and how EVs can be created efficiently and how the networks can be built over time. So yes, we are bullish on those companies, but I like IT only not for saying कि IT information technology में लगाना है. I want to invest in ITs which are, the new factor is there. I want that relative change factor for IT. And specifically, sometimes what happens is that one sector has been pushed so much because of a certain event. Post-COVID, the IT companies generally were pushed to a valuation which were not sustainable, not only in India. India did not see what the world has seen post-COVID, right? All these FANG stocks, and they were at valuations which are crazy. But still those companies have relative change working for them. We were talking about marketing, I am telling you, as these FANG stocks, they've created something very, very different. The total, as a fund house, I can tell you the total spend that I have on, so it's very, very secretive, but I'm telling you, the total spend that we have on our salaries is less than what we are paying these FANG stocks. Yeah. So
pure moat.
Yes.
No options.
Pure moat. Yeah.
No
so,
options.
Yeah. No. So this is what you have to focus on. And I believe it is now a very, very global economy. If I have to invest on quality, if I have to invest on IT, if I have to, especially these two sectors, why should I invest in India? अगर मुझे टेक्नोलॉजी लेना ही है, then why not go and buy Nvidia? Why not go out and buy Facebook? जिधर मुझे पता है, for me, I don't spend anything in TCS, but I am spending say 5 lakh rupees a month on Facebook for my advertisement. They have created something great. So why just Indian IT? They have much better, and Indian IT, I believe, is a laggard. They are not creating anything new. Yeah, because the only factor is that we as a country, we are not focusing on innovation. We have started moving in that direction. Yes. Will it take time? Yes, it will take some time. But yes, look for something new, and that is, I think, that is what excites the market, and that is how you create alpha.
So when we find something very structurally change in IT, that's an interesting thing.
Yes.
I'll tell you an example. I come from a city where 90% of the solar units are being made, right?
Mm-hmm.
Everybody calls me and says that should we buy this solar company, and these are at quoting at 100, 200, 300 times. And I don't understand why people want to buy solar at this valuation. But वो बोलता है ना, जब तक चलता है तब चलता है. So till the music is on, we all dance, and then as Warren Buffett say, when music stops, you know who is naked and who is wearing clothes. So on that note, guys, give a round of applause to this great gentleman who shared their immense knowledge. And thank you for being so open and transparent. I think so we had a great chat, and we are going to take a lot of knowledge out of it and making a lot of value for our own portfolios. Thank you, gentlemen.